All right, well, Jake, it's 12:01. I think I'll just kind of kick us off with an introduction, if that's okay.
Great.
All right, great. So I just want to frame this up for everybody. First of all, thanks for attending. This should be a lot of fun. We're going to try to keep this to the standard lunch hour and hope to impart a lot of wisdom and a lot of information. We've done a really deep dive and studied what's going on in the housing market and how that's going to impact housing values. You know, the number one thing we've been hearing from clients is the stay-at-home orders have made them abundantly clear whether they love their house or they don't love their house. But there's no question in most of our clients' mind right now. They're either one or the other, on one camp or the other. And so, although I'm feeling there's a lot of clients that want to move, there's fear and trepidation around what's going to happen in the housing market. And there's this mental link for most of my clients that says, okay, economic recession, that equals housing crash. Because the last economic recession was based in the housing market. We had excess debt levels. We had unprudent underwriting guidelines. People went out a little too far over their skis and did the front end of, and that imploded the economy. But this is a very different recession. This is a virus recession. I don't mean to make light of that, by the way, but this is a very different recession than what we saw for the housing crash. So we're going to dive into a lot of charts, a lot of data. You're not going to get opinion. You're going to see the real meat, the real economic data of what we're looking at and why this is very different than the last recession. Jake, before I kick off the first slide, anything you'd add there?
Yeah, there's another thing that we're collecting data on, but we're really showing that experts are saying COVID has fast forwarded some technology. So take Zoom, for example. It already existed for years, but because of the pandemic, we've fast forwarded that technology. So if we talk housing in general, it's also quickly fast forwarding a lot of the housing types, uses, and tech that have existed for some odd years, but consumers didn't use them in the masses. And now we're seeing that come to fruition really quickly here. So in a lot of ways, it's not just about, is housing going to go up or down, or is this the time I move? It's a massive change in our industry. And Josh and I both have a deep interest in looking into real data. And that's why we titled this Debunking the Housing Crash. And so we'll take a deep dive as to why.
Yeah, fair. All right, brother, thanks. I'm going to go ahead and share screen number one. Jake, just give me a thumbs up if that looks right to you. Thanks, buddy. Okay, cool. So here's the fear, and I think it's a valid one. You know, COVID-19 is probably one of the most deflationary global events that has ever hit the earth since the meteor that took out the dinosaurs. I mean, never in the world have we seen a global event that has caused people to close their shops, close their restaurants, close their industries, and stay inside. This coordinated global event is truly unprecedented. So the question then becomes, if this is a deflationary event, meaning asset prices globally are likely going to go down because there's just less economy. And we know that the stock market's doing pretty good right now. But if you look at most businesses, you look at what the airlines are telling us, you look at a lot of different businesses that aren't even given economic forecasts, we're seeing a contraction in the economy. And that usually equals deflationary pressure, lower valuations of all kinds of asset classes. So the question is, if that's our current reality, which the news is reiterating to us over and over and over, how is it that US housing can still do well? Well, there's 5 reasons. And the thing that we need to keep in mind around housing is that there are equally, if not greater, inflationary pressures that are currently pushing housing prices higher. So here they are. We've got record low inventory. We've got rising home ownership rates. By the way, the new home ownership rates for the second quarter just came out. I think it was either yesterday or the day before, and it's blockbuster. We have changing demographics. That's going to be an incredible slide that is going to take a lot of people by surprise. And we have home prices aided by low interest rates. We're going to show you what happens to housing prices in most recessions and how that's linked to interest rate fluctuation. And what's very different than the last recession, probably one of the most stark contrasts, is the amount of equity that Americans have in their homes before. The amount of equity that Americans have in their homes now as compared to the last recession. Jake, I think you wanted to show something at this point. Is that right?
Yep. So Josh and I are going to switch back and forth just a bit here. We realize our audience is relatively Utah-based, but there's a lot of people outside of the state of Utah. So we're going to share kind of macro and micro info. Most of the micro will be me. I'm an expert in Utah real estate, namely Wasatch Front, Wasatch Back, Salt Lake City, Park City areas. But we'll speak to a lot of the national market too. So in layman's terms, a lot of people think, okay, if things soften, then we should be experiencing a crash. And that's probably a simple way to put it. And what they mean by crash is that prices go down. And I can't tell you how many times over the last 120 days I've heard from buyers who say, well, I'll wait for it to soften, especially this fall and winter, it's going to soften. But specific to inventory, let me just show you exactly what we're experiencing in Salt Lake, which is unprecedented. This is a live look at an absorption rate, and I'll dive deeper later in the presentation on inventory levels. But this is a live look at absorption where if you take the number of properties in escrow under contract and or sold over the last 2, 3, 4, 5, 6, or 12 months, meaning any way you want to slice the apple, and then divide that by the amount of active homes we have for sale, it's just absurd. In Salt Lake County right now, as of this morning, we have 1,425 homes for sale. If you divide that by what's sold over the last 2 months, it's leaving 2.56 months of inventory. If you transfer that to an absorption rate based on what's selling in escrow, because people have said, oh, well, I got to assume a lot of people aren't buying during COVID or people haven't house shopped. If you divide it by what's closed over the last 2 months, we have 0.63% of a month's worth of inventory.
Wow.
Guys, that's less than 3 weeks of active inventory. And I have not altered this. I have not removed luxury pricing, say over $1 million. That's everything.
Wow. I've got to imagine that's somewhere near a record low for Utah.
In my 17-year career, it's the lowest I've ever seen.
Yep.
And we were already in a low inventory market prior to COVID. So it's truly unprecedented.
So that's the local data. Let's take a look at what's going on nationally. And this data was from the fourth quarter of 2019. But what I think is important is to look at the difference between 2007, which was the peak of the last real estate market where prices were kind of towards their highest. And we had 3.7 million homes for sale nationally. Now, fast forward as we enter this economic contraction, this recession, we have 1.8 million homes for sale. So your inventory nationally, and again, this takes luxury and everything else like that into consideration, you have less than half the amount of inventory available. So think of it this way. In the United States, we've got 1.8 million homes for sale, and we have 328 million people in the country. And there's 128 million households. So if you have 128 million households and only 1.8 million homes for sale, that is 1.4 homes for sale for every 100 households. That's just simply not enough inventory, because if you look at 100 people, people usually move about every 7 to 10 years. That would tell you that there would be somewhere between 10 and 13 households looking for a new home this year out of every 100. But there's only 1.4 home for sale. So it's a gross shortage in the amount of homes for sale versus what's needed out there.
Yeah, and Josh, I'm going to show just one more thing here. There's a million ways you can slice data and show it. But this is my favorite way to look at Salt Lake and Utah as a state right now. So this is a snapshot of the active number of homes coming up for sale on the market every day since January through today. And the orange line is 2019. The purple line is 2020. And this is all of Utah. This is our entire MLS system. As you can see, when COVID hit, we were already listing less homes on the market on a daily basis in 2020. And then the gap has only widened. So fast forward to yesterday. Yesterday in 2019, we had 9,876 homes on the market. Yesterday in our state, we had 5,400. If you look at Salt Lake County, yesterday we had 1,435 homes for sale. Same day last year, 2,686. Okay. And then contrast that. That's how many are coming on. Contrast that with how many go under contract each day. And look how the graph inversed. And although we have far less inventory, if those of you kind of running quick math in your head, 40-ish% less inventory, yet on a daily basis, look where the chart crossed purple versus orange, meaning around May 1st, even with 40% less inventory in Salt Lake County, we started contracting more homes on a daily basis than the same day last year. Mm-hmm. And for you locals, you got to remember how strong our market was last year. Okay. So Salt Lake County, yesterday, we had 3,134 homes pending with 1,425 available for sale. These are just the most insane inverse of contract versus active inventory we've ever seen.
Yeah, big time increase in demand and lack of supply for sure. All right, so let's move into reason number 2 that we're going to debunk the housing crash here: rising home ownership rates. So I find this really fascinating. And what you'll see here is that the home ownership rate peaked here around 69% in 2005. And if you take yourself back to that time, we remember what was happening with house prices. They were just astronomical. They were just going through the roof. And homes became unaffordable. And then we hit the economic recession, the Great Recession, and we start to see the home ownership rate drop, and then boom, really just kind of fall off a cliff here. Well, this range from, let's call it 2009 through 2017, you have to realize that the millennials that were at home during that time saw their parents lose jobs, they saw them lose their homes, they saw them lose their retirements, and far too many of them lost their relationships and marriages. I mean, I had an unbelievable amount of clients came to me during that time that just says, you know, we can't weather the economic storm, we're breaking up. So you have these, you know, these children, these what would have been first-time home buyers have all this trauma around housing, and it's really taken us a full decade, 10 years. Well, starting somewhere in late 2016, the homeownership rate started to go up a little bit, but look what happens in the fourth quarter of 19 and the first 2 quarters of 20. The homeownership rate starts to skyrocket higher. Now, what's interesting is these gray bars, which you're going to see throughout this presentation, if there's a gray bar in the presentation, that means that that's a recession. So to see the homeownership rate skyrocket in spite of a recession is incredible. And the homeownership rate as of the second quarter is back up above 68%, which is pretty darn incredible. We're very close.
And one other way to look at this too, guys, is Josh rattled off a couple slides ago, 328 million people in the US, 128 million households. And if you look at this graph of home ownership rate from peak to bust, there's a difference of 4%. Okay, so if we were where we are currently at in, say, bottom of 2017, and we were to go back to the peak of 2005-06, that's a difference of 4%. If you translate that to number of households, that means we're about 4.5 million households short of the peak. What's very interesting about that number to me is that's about the same amount of single family houses that sell annually in the US.
Wow.
In layman's terms, we're about a year's worth of sales off in home ownership rate, and everyone's surging back. We'll explain why we think why, but they're surging back to the market right now while we also have unprecedented low inventory.
Thanks for the segue. All right, so reason number 3 is that demographics are changing. And I find this correlation shocking, and I'll try and explain it as succinctly as possible. But on January 22nd, 1973, the United States Supreme Court affirmed the legality of a woman's right to have an abortion under the 14th Amendment, also known as Roe versus Wade. So if we know that the average, I'm actually going to talk about the age of the average homeowner next, but the average age of a first-time home buyer is 31 years. 33 years, excuse me. That's the average age of a first-time home buyer according to the National Association of Realtors. If you take 1973 and you overlay 33 years, what year is it? It's 2006. So let's look what happened with household growth. We see going back to 2002 on the left side of this slide that we had in the blue line lower household formation and growth than we did annual housing completions in the orange line. Same thing in 2003, less household growth, more household completions, similar in 4, similar in 5. But look what happens in 2006, my friends. 33 years after Roe versus Wade, you start to see a distinct reduction in the number of households. So right as the real estate market was reaching unaffordable levels because of the rapid appreciation, we also had the demographic trends reverse, less new household formations as a 33-year delay from the reduction in birth rates due to Roe versus Wade. And had home builders been looking at this trend in 2006 and went, wait a minute, we've got way more annual completions of homes than we have household growth, and household growth is dropping like a rock. We need to stop building homes. Unfortunately, builders weren't looking at this slide. And then you'll see here's the after years, the effects after Roe versus Wade. Less annual household growth, less growth in 9, 10, 11, 12, 13. All right, 14, we start to see an uptick in household growth. 15, we start to see more household growth than annual completions. Jake, I don't know if you know this off the top of your head, but what were the appreciation rates in Utah in 14 and 15, if you just had to take a guess?
Yeah, we were 12 to 13% median price appreciation in Salt Lake that time. It was just skyrocketing.
There you go. So here's what happened. We had way too many annual completions, too much supply. We had not enough demand, not enough household growth. And we had a crashing value through 10. And then we started to pick up maybe 11. We started to pick up the number of household growth. As soon as household growth catches up to annual completions and starts to exceed annual completions, 15, 16, 17, 18, 19, the same thing will be in 20. You have massive, massive appreciation.
Yep. And here's one other thing, Josh, if I can take over screen share for a sec.
You bet.
I'm going to shift here from data talk to street talk. And I like to do that fairly often when we're presenting. But in layman's terms, one thing this graph, here's a hunch, okay? I'm not proving it in data. The graph doesn't go over it. But the other thing I keep hearing, you'll see a lot of articles about the last couple of years, is just affordability. And a lot of consumers I meet with from Street Talk, they're kind of like, well, why don't more builders just build more houses? Why can't we just do affordable housing? I won't go off on a major tangent there, but what we're also seeing due to this technological change, and I said kind of COVID fast forwarding some things that have existed, but now consumers are using them in droves, is the need for builders to build at an affordable price demands a new type of product, matched with what Josh went over in age demographic of the first-time home buyer and the waves. We'll dive deeper into the type of buyer coming up soon. But they're demanding a new product. A new type of product has to come to market. And I just wanted to take this segue to share an example with you. And if any of you are local, we've got this home I'm about to show you in the Salt Lake Parade of Homes, which starts this Saturday. And right at the mouth of Big Cottonwood Canyon. You're actually gonna be able to see this in West Jordan at the Salt Lake Home Builders Association parking lot. But here's a picture and a video of us delivering a new type of product to the Salt Lake market 2 weeks ago at the mouth of Big Cottonwood Canyon. And this is the type of stuff that is famous on Instagram and Facebook and YouTube, and everyone wants to talk about it and make videos about it, but it's rare to see this type of product live. Why? Well, bureaucracy, city approvals, all these types of things are kind of roadblocking it. As these floodgates open, and trust me, they will, you're gonna start seeing new type of product. And if I was really to define it, not by style, but by what it's gonna be, smaller. That's the only way to make product more affordable in this market. You're gonna start seeing smaller product.
Great share. All right, so I'm just continuing on with this demographics. I just wanted to show, Jake talked about 10, 11, 12% appreciation in Utah, but this is national. This is the median sales price for homes sold in the United States. We talked about that period between around 2012, where it started to level out, where there was equal amount of new houses coming to the market and equal amounts of new household formations. And then by 2014, new household formations exceeded the number of homes being built. Well, boom, nationally, that set off this rise in home values. So not only locally did that effect happen, but nationally that effect happened. Again, I just want
micro Utah stuff too here on that same.
Want me to pause here?
Yeah, let's go forward. Yeah, you're fine right there. These are my favorite type of charts to explain because I like to look at the peaks and valleys of price appreciation. And really what you saw nationally was a 30% decline in the recession. And so we all kind of remember those times. I'm going to put Salt Lake specific info up here for you. And I've reversed this. The blue line, this is a quarterly snapshot, and the blue line is median price in Salt Lake. Without diving in, and I know the numbers are jumbled, so don't try to psychoanalyze this graph, but what's happened here in percentages is prior to the recession, 2006, we had peaked at a median price of about $260 in Salt Lake for a single family home. At the bottom
where
of the
is that,
recession,
Jake? Could you circle that on the screen? Sorry.
Yeah, right here.
Okay, got it.
And then we had bottomed out in 2012 190. So if you wanted to blanket statement in Salt Lake, you could say the average homeowner lost 34% in value in a 4-year period. And that's kind of old news to us at this point. What I feel like we often forget is what happened after. In Salt Lake, it only took just under 2.5 years to erase that entire downturn. So if you reverse your mindset back to 2012, 2011, a lot of people were saying things like, prices will never go back. It was the biggest
20 years.
Ever experienced. Yeah, it'll be 20 years. We'll never get back that kind of pricing. Boom, 2.5 years later, we've erased it. And look what it's done since. Okay, we're now at a median price in the second quarter of 2020 of $410 for a single family home in Salt Lake. We have, if you're running the math, from 190 to 410 in an 8-year period is well over doubling. It's up about 127%. Nationally, if we were to reverse back to that same graph, in about the same 8-year period, median price nationally has gone up 70%. Now, when people hear just that, and this is the reason we're doing this presentation, when people look at graphs like just this, they almost immediately say, yeah, well, it's going to crash again. I mean, look how much it's gone up. But you really got to take this deep dive we're doing and look at all the other factors, because this is not a housing crash, potential crash because of a housing bubble.
Great, thanks, buddy. All right, I'm going to go back to sharing this next screen here. And I just wanted to point out again here that builders have not been able to keep up with demand. You see, this is the total number of housing starts going back all the way to 1960. And if you kind of just, those gray bars again, friends, are recessions. And if you kind of just drew a line through the center, kind of the average, right through the median here, seems to be about 1.6 million housing starts. Going back to the 60s, we spent some time below, we spent some time above 1.6, but that seems to be kind of the center line through this trend over the years, if you were to level out the peaks and the valleys. Well, this is what's really shocking when we talk about the supply side, is that over here, right around 2007, we see this number of new homes being built, the supply coming into the market, just absolutely drop like a rock, hit the lowest numbers it's been going back all the way to the 60s. And what's so interesting is over the last 10 years, it barely made it back to 1.6. We spent a full decade below 1.6 million housing starts. Look at the 60s, look at the 70s. Look, we've never spent a decade below 1.6 million housing starts. And to the very far right, do you see the graph just crash down again? Well, that's the first quarter of 2020. And you start to see well, actually, I'm thinking this data was probably through June. So we start to see the impacts of COVID and housing starts stop again. So again, this just speaks to what's going on with the supply side, where we have very limited supply. And again, this slide speaks to the demographics and the buy side. These are the people that are going to be coming into the housing market. So if we look back, these are the births from each generation, all right? So we talk about what was going on, the number of people that turned 33 in 2006. Of course, these people were born in 1973. We see this drop. We see how the demographics go down. There's less people born during this time, meaning that 33 years later, 2006, you have less people turning 33 years old. That's where we had that housing crash. Now, fast forward to today, we're in a very different place. We start to see today that we have an increasing number of people turning 33. So while we have a limited amount of homes, because builders haven't been keeping up, we have a rising amount of demand because more and more millennials are turning 33 today. That's on an upward trajectory, and 33 is the average age of the first-time home buyer. Jake, that's a little bit of a complicated slide. Did I explain that all right, or do you have any questions on that?
Yeah, I'll just add a little bit to it to perhaps clarify. So if in street terms, back to kind of some street talk, a lot of people ask me, well, why don't builders just build more? Or when the market started surging back post-recession, 2014, 15, 16, a lot of builders then, you saw cranes come back down to downtown Salt Lake. You drive down right now, and prior to COVID, you're just seeing tons of new apartments being built. So all these types of housing types are surging back. And so in layman's terms, most of us look at that and say, yeah, in a good economy, builders build, and in a bad one, they don't. But if you're paying attention to the last two graphs, the opposite should be true. Really, builders should be building or entitling land and doing all they can to build right now, especially if you add on top the wave of first-time home buyers that are coming to market, turning 33 years old now, versus Gen X becoming first-time home buyers. That's the age demographic point. If you consider the softening of the supply chain around the globe because of COVID, although it's difficult to get supplies, it's making it hyper competitive, and it will put downward pressure on build costs. Okay, so the begging question becomes, well, why then? This economists could break this down, and they would be advising builders to bring product to market. My personal opinion, why you are not seeing that, is just purely cost. It's in Salt Lake County right now, the price to deliver, and I'll just show you so that I actually, Josh, if you can turn me screen share, I'll just give you some live examples so you can see we do know what we're talking about. We don't just make up numbers. Here's some custom homes that we have delivered to market within the last year and a half. And this is on breenhomes.com. My brother's the contractor. He's Salt Lake Home Builder Association president, so he knows his stuff. really kind of this type of custom quality, guys, you're looking at an absolute minimum hard cost of $150 a foot to, you know, more modern style people are wanting around $255 to even $300 a square foot. So although builders are not naive to the fact that product is needed, it's really, really difficult to bring that to market at an affordable cost. And it's, if you're catching our hunch here, adding inventory of existing single family homes to this discussion, you really see the opposite of a bubble that we're building.
Yeah.
it's the, what's the opposite of a housing crash, right? And that's why we're really debunking, that's the point of this presentation, is debunking any sort of doubt you could have that the housing market continues strong. Until we see inventory changing, first-time home buyers coming to market slowing down, and build costs soften, there's just absolutely no way we see a devastational crash.
Yeah, and so reason number 4, to continue down that trend of thought, Jake, is that home prices are aided by low interest rates, meaning that you've got an inverse relationship. The lower the interest rate, the better that home prices do. If we look back over the S&P Case-Shiller U.S. National Home Price Index, we're going back to the 70s, so we're talking 50 years. You're going to notice that we've got these gray bars, and these are the economic recessions. We've had 7 recessions in roughly 50 years. So recessions, well, I guess 8 if we're now counting 20. And here's what's really interesting is look at what happened in 71. Look what happened in 74. Look what happened in 81. Look what happened in 83. As we go into these recessions, the blue line, which is the average value of the National House Index price, you see that these real estate prices actually go up through these recessions. That doesn't make sense. Actually, I think in 91, home prices went down 1.9%, not substantial. In 2001, we had another recession, home prices went up. So where's the clear outlier? Well, the clear outlier is obviously the Great Recession. The epicenter of that recession was in housing. We had too many homes being built, more houses being built than we had household formations. And we had house prices go too high, and we had a bubble in the lending industry. That all imploded at the same time, and we saw housing crash. So the question is, why is that? If we look back at those 7 recessions, how come the first 6 did pretty good? That really doesn't, I mean, if we looked at what happened to stocks during those times, they got obliterated. It was a bloodbath, 20, 30% killing. Well, here's what happens. As soon as there's an economic recession, the Fed steps in to try to stimulate the economy. What's the first lever they pull? Reducing interest rates, right? So if I go from, if we just look at what's going on right now, December, not last December, but the December before, we're talking about a 5% interest rate is about where the market is. As soon as the economy starts to slow down, Federal Reserve steps in, floods the market, buys mortgage-backed securities and treasury bills, pushes down interest rates to around 3%, and that makes housing more affordable. So even though that housing prices are going up, the affordability factor remains about the same because interest rates have gone down. All right, so I'm going to jump into home equity. I'm going to try and move quickly through this because I want to make sure we have time for questions. Feel free to throw your questions into the chat. I already see there's a couple of chats in there, but if you've got those questions, we want to answer them at the end. But I want to contrast the 2006, 2008 recession to what we're seeing now in terms of home equity. And I found this slide really fascinating. This shows the amount of equity in homes in America. And if on the left side of this axis, you're going to see the percentage of homes, right? So that line 1, 2, 3, 4, 5, that's the percent of homes. And in the bottom is the percentage of equity. So if we're to look in that very far left, you'll see that in 2020, the teal line, there was just under 8% of the homes had 50 to 49% equity. And just under 9% of the homes had just under 59% equity. But what's really, really interesting here is that today, 87% of homeowners have at least 20% equity in their homes. And 95% of homeowners have at least 10% equity. This data is provided by CoreLogic. You can see that from the 90 to 94% equity to the right, there's a very small percentage of homeowners. And as you go to the left of that, the large amount of homeowners have this, let's call it 80 to 50% equity. It's just a very different world than we were in 2008 when people were using their homes as ATM machines. They were just pulling out cash with equity lines. They were very highly leveraged, low equity levels. And then when the market slowed down, of course, they had no choice but to sell those homes in foreclosure situations. So here's a couple other great facts. 58.7% of all homes in America have at least 60% equity. It's a lot of equity. 42.1% of all homes in America are owned free and clear. 42 out of 100 homes in your neighborhood are owned free and clear. Well, that's true across the country, maybe not in everybody's neighborhood. And the average amount of equity across the United States of the homes that have mortgages, not the free and clear homes, just the homes that have mortgages, the average amount of equity is $177,000. Jake, anything you want to add there before I move on to affordability?
Nope.
All right, moving on. All right. Okay, so when we think about affordability, we can't just think about price, and that's where people's mind tend to go to. They tend to go to, well, the price is high, it's not affordable. But there's actually three components to affordability. So the first component is, what is the mortgage interest rate, right? Because that's going to correlate to what your payment's going to be. The second thing we need to think about is, what are those mortgage payments as a percentage of your income? And then the third component is home prices. So what we've seen is that, yes, home prices have gone up, but mortgage interest rates have gone down. And over the last 10 years, we've seen consistent, although not stellar, but consistent increase of hourly wages. So folks are making more money now than they were before. Interest rates are certainly lower than they were before. And yes, home prices are higher, but you kind of get an offset there in regards to affordability because you've got higher incomes and lower rates. So if we look at the Housing Affordability Index, this comes from the National Association of Realtors, and it creates a score around affordability, if you will. And the higher the score, the more affordable that home is. So we want to see nice high scores. Well, let's go back to 1990, and we saw relatively affordable housing, but those scores were coming in between 108 and 138 over roughly a 20-year period then. And then boom, we start to see affordability get a lot better from 2009 to 2014. Well, what was going on there? Well, we started to see the housing crash. So housing prices were going down. We entered into an economic recession. What did the Federal Reserve do? They pulled that interest rate lever. They dropped interest rates down. So now you had much lower home prices, drastically lower interest rates, really, really great affordability. Now, that was a period when people were freaking out. Like 2009, 2010, 2011, if you were in Utah, when did it start to pick back up, Jake? What year was it in Utah?
Winter of 2011 into spring of 2012 is when we bottomed out. And what's funny is if you take Home Affordability Index and you overlay unit sales, which is just a factor of, are people buying? Funny thing is, we all can look backwards now and say we wish that we would have bought this or that in 2010 or 11 or 12. And all of my clients that bought did phenomenally. However, unit sales were still extremely suppressed until the end of it, 2012, right? And it's that fear that makes all of us, including myself, go, ah, man, I don't know. Is this the end? Could it get worse? But over that 4-year period in Salt Lake, again, we saw pricing go down 34% in 4 years based on median price. We saw interest rates, once the economic situation was bad enough, back off about 1.5 points. And so affordability shot up. And that's really when everyone should have bought. But then fear made us not take those actions for another couple of years.
Right. And the correlation I'm trying to draw is this. As the affordability index goes up, if we overlaid the housing appreciation, we saw that nationally around 2012 to 2014, you really started to see some appreciation start to occur. So there is a direct correlation. When you have high affordability scoring on this index, you're going to see above average appreciation. And the point is, today, when you factor in near 3% interest rates, housing affordability is getting better. So we're kind of at this, back in 2010, you had this 172 affordability score. And I don't know that we're going to go back to 10, 12, 13% appreciation rates. I'm not necessarily predicting that. But if you're seeing demographically more buyers coming online, builders not being able to keep up with demand, and housing becoming more affordable, what conclusion do you arrive at? All right, so let's get to the conclusion here, Jake, because I want to open it up for some questions. So here's the conclusion. Demographics and home ownership rate indicate more first-time home buyers entering the market than ever before. And by the way, that demographic trend continues for about the next 10 years. The inventory of new and existing homes seems likely to continue the trend towards record housing inventory shortages. That's what Jake just told us on a Utah level. This is the lowest inventory he's seen in 17 years. Multiple offer situations and more buyers than sellers. Historically low interest rates result in a market that is more affordable than any time in the last 7 years. So I'm going to end with a quote. I'm going to have Jake tell a final story, and then we'll open it up for question. But I thought this was super insightful. The quote reads, "Use time, make it easy. Get your money to work for you. The key is to get in the market, as it is not about timing the market, but time in the market that matters." To Jake's point, the reduction in values in Utah was over 4.5 years. It only took 2.5 years to get that value back. I remember the first condo that I ever bought. I'm going to turn this back over to you, actually, Jake. The first condo that I ever bought as an investment property, we paid $86,000 for it. We put $15,000 in renovations. And by the time we listed it for sale in the MLS, there'd been 3 short sales that sold in the condo development. And those sales now were pegged at about a $79,000 value. So we were upside down $21,000. And I thought, man, we can sell this thing, or we can find a renter, and we can let time work for us. Well, that was about 18 years ago. Fast forward today, that same condo that we were in $100,000 is worth about $265,000. We've paid off the mortgage, and we have a tenant that's in that thing paying us $1,200 a month. So again, my point is, it's time in the market, which is more important to wealth and real estate than timing the market. Jake, I'll let you take it over, buddy.
And I'm just going to give you one other kind of street example. This is a live example of a client that both Josh and I helped in just the last 30 days. And this will show you where the rubber meets the road on affordability. So I had a client that bought this home I'm showing you 7 years ago, and he paid, let's see, $253,000 in 2013, and then we just sold it in July, and it sold for $510,000 in 2020. So if you're running the math, in 7 years it doubled. Now I know Salt Lake's a hot market, but nationally you'd still see about 65% appreciation in that same time period. Okay.
Jake, did he do a renovation on? Did they do a reno on that property?
They didn't do a full remodel. They just kind of spruced it up as they lived there. They did take out a home equity line of credit that got paid off when it sold of about $45,000.
Okay, so it wasn't a massive remodel.
Right, and I'm going to give you some math here, but let me just show you what they upgraded to just a couple weeks ago. So follow my math. They bought for $253,000. They sold for 510. They then purchased this home for 735. Kind of same area and neighborhood, great schools, but they doubled their square footage.
Wow.
And got something that's already redone. Okay. So doubled their footage, newer home, nicer lot, and all that's great. But listen to this math. I just find this amazing. This is where we talk street versus data and graphs. Their old home in 7 years doubles. Okay. Their interest rate on the old home, they had a mortgage for $278 because of that line of credit. And so their old home payment with principal and interest was $1,466. Their new payment, Josh got him the loan, their new rate was 3.49. It would even be better 30 days later now. But their payment was $2,100. So that's a difference in payment to upgrade to this $735,000 house of $600 a month, principal and interest compared to each other. However, it gets even better than that. With the doubling of that house price, to make the switch, they only put $149,000 down on the new place, thereby pocketing about $70,000 and only having a difference in payment of $600, doubling their square footage in the same neighborhood. Okay. All right. People listen to that. They go, wow, that's pretty amazing. Let me really apply this to everybody. I have a theory here. We have a good half century of data in the United States, solid data in Salt Lake I've looked at that says in layman's terms, housing prices double every 10 to 12 years. And as you watch housing prices from the 50s go up and double every 10 to 12 years, you've also seen interest rates go 21, 18, 16, 14, 13, to where we are today, effectively a Fed's rate of 0. What do you think happens in our generation over the next decade? Well, there is no longer a silver bullet of continuing to lower interest rates when they're effectively 0. They might translate a little bit, but not have themselves from 18% to 9% over a 10-year period. So fast forward 5 years, COVID's over. Let's say we're in a good economy. Let's say you have a great job. You've got tons of cash and you can afford to now upgrade versus maybe you having some fear and stressing to do it now. Let's suppose that's what 5 years out looks like. Let me tell you one factor you possibly haven't thought of that makes you not want to upgrade even though you can afford it. Rate. We haven't seen an inverse of rates where they go from 2.75 to stabilizing out to curb inflation in the next 5 to 10 and say rates 4.25. I know I'm speculating and on a tangent, but we have never seen that for a sustained period ever in the United States. So what happens? Again, street talk, I believe, and I'm calling it a freeze. I believe we won't have a housing recession, we won't have a crash, but that will cause a freeze. What's a freeze to me? It means a lot of people can afford the payment, can afford the down payment, can afford all that and they'll want to upgrade, but their current home that they're in right now that they didn't move out of during the phenomenal affordable time, they'll look at their rate and say, why would I upgrade and then lose my 2.65 rate? And we all know everyone and their dogs refinance too. So that's another reason why the opportunity really is now. We don't try to give people a sales pitch and pressure you to do something, and I'm usually not a fan of leverage for those that know me personally, but now's the time if you're going to do it in the next 5 to 10.
So Jake, what you're saying, just so I make sure I'm understanding you, is you're saying that when you say a freeze, you're saying that if I buy a new house at a 3% interest rate and 5 years from now, 7 years from now, my needs preempt me to want to buy another house, I'm going to be frozen in my current house because I'm not willing to go from a 3% interest rate to a 5% interest rate. So because those people are frozen to their low interest loans, there's actually going to be less supply of homes coming on the market from a resale perspective. Is that what you're saying?
Yes, I truly believe, and we've never seen this before, but I believe a lot of people will go, I got the cash, I can get the loan, job history, all that's great, but why would I, even if the debt amount, let's say the mortgage is $500 on both properties, people are going to elect not to move because of rate. And so it kind of freezes them in their home. Is this everybody? No. But a lot of people will make that decision.
Makes total sense. Hey, are you ready to jump into questions? We've only got about 9 minutes left.
Yep.
There's a couple of questions in here. Should we roll with those?
Let's do it.
All right, I'll be the narrator. You be the smart person. Do
got
you
it.
believe a similar trend will occur in areas like Park City, where many lower end properties are vacation homes or rentals? And I think that was in regards to one of the slides that showed that we have limited number of inventory and increasing demographic first-time home buyer demand.
Yeah, let me address that in several ways. And Cheryl, if I don't answer it specifically, feel free to reach out to me after and I'll give you specific answers to your question. But a couple things about Park City. One, Berkshire Hathaway, our company, we are over 50% market share up there. So I have phenomenal intercompany data on that market. And last week, which was a 4-day work week because of the 24th of July, that's a holiday here in Utah, we pended as a company more volume than we ever have in our history. We did 104 million in pending contracts. Okay. And most of that inventory was between 1.5 and 5 million asking price. That market, it's hot. We could pontificate on why people moving from East and West Coast, wanting mountain marks. I'm not going to speculate, but it is insanely hot. When it comes to rentals, we are seeing demographic and zoning changes left and right, and municipalities are finally jumping on board. You do realize a lot of people who are renting out on Airbnb and VRBO throughout the nation are doing it illegally. They're against zoning code, but it's not being enforced. And that type of rental market is now demanding change on the city zoning level. So again, we're talking 5 to 10 years out. Yes, I believe we'll adopt laws that support what consumers want to do. And if you run the math, that will only continue to bolster that market. So yeah, I'm very bullish on Park City appreciation. One caveat, you can't take median price appreciation percentages. Like when I say the Salt Lake market, that client I just showed you, the live example, whose house price doubled in 7 years, that's 100% appreciation in 7 years. You can't apply those exact same percentages to the luxury market. It's not to say luxury is going to double, but point is I can always hyper analyze your specific situation. And if it is in luxury, I can always say, all right, here's luxury specific data and give you real answers that are specific to your situation.
Cool. This is a great question. I love this question. This came from BP Films. So BP says, if the home market is struggling to supply enough inventory to the Salt Lake City market, why am I noticing so many price adjustments on SLC homes on websites like Zillow or Redfin? Put another way, if it's a seller's market because there is more demand than there is supply, it seems like there would be bidding wars driving listing prices up, not relisting them for lower prices in order to catch a buyer. Thank you for your time. Great presentation.
I love this question. Thanks for asking, because this is the type of stuff that if I post a graph or chart in social media and people see that I'm a realtor, fairly often I get blasted and they go, oh, you're just saying it's always rosy. It's always a good time to sell, always a good time to buy because you're a salesman. So let me give you data specific answers to your question. So thanks for asking. One, as I showed earlier, in the last 30 days, we've pended 3,362 homes in Salt Lake County. 60.2% of those 3,300 were multiple offer situations, okay? And in fact, there's an article on KSL this morning that goes over some of this data. One. Number two, be careful on where you get your data from. So Redfin and Zillow don't have what's called a live IDX feed into our MLS system. In layman's terms, since I'm short on time, you're getting bunk data that's not accurate or out of date. Three, why are you seeing little red arrows on websites that people are doing price adjustments? It's this simple. They overpriced. You can be in a phenomenal market, yet people overprice all the time, right? So we're all zealous. I do it on my own properties. Josh and I own quite a few rentals. We always shoot for that dream price out the gate. But let me tell you two factors that every consumer tries to hang their hat on when they're trying to get a good deal when they're buying, that I educate people no longer really matter when it comes to the overall market. One, price adjustments. 2, days on market. I have consumers all the time. Oh, well, I'll get a really good deal. This one's been on the market 100 plus days. No, that just means the seller overpriced. You watch, the second their price comes in line, they'll have multiple offers. It'll sell in a weekend.
Well, I think that's a good thing. I think what you're saying is this isn't a wild, over anxious, overzealous feeding frenzy that whatever price hits the market, somebody's willing to pay, which would be emblematic of a bubble type situation. You're saying that when a good home in a good area hits a reasonable price, it's selling fast and there's a very little inventory of those homes for sale.
Yeah, exactly. And everyone shoots for the stars out the gate. We're all, tied to our personal homes, especially if it's your personal residence. And realtors do it too. Let's start with this. The market's crazy. There's no inventory. Let's see. And some people, I try to advise my clients when we shoot for that dream price to adjust every Monday, but in small increments. So if you look at some of my listings, they have a lot of price adjustments. And we know we maybe overpriced a little bit to see if anyone would do it. But, after 4 price adjustments, 5 weeks later, it helps my client psychologically sleep better at night to know we tried for one price. But then as we come down 3 or 4 times swiftly, all of a sudden we have multiple offers. So don't let price adjustments make you think the market's crashing or softening. You got to look at kind of the all-encompassing picture.
And hey, Jake, you mentioned that Redfin and Zillow don't have live access to the multiple listing service. They're buying information on delay. That could be 2-3 weeks dated or not even accurate. Maybe the home sold and it just didn't get updated to their feed. So there is a platform that Jake and I both have stumbled upon called Home Scout. And Jake, let's do a follow-up email to everybody. Give them a link to Home Scout because Home Scout has a live API, is that the right initials?
Yeah.
ABCQRS, yes.
API, you got it.
It has that. It goes right into the MLS, essentially gives a buyer the same capability that a realtor has with direct access into the multiple listing service. And Jake can send a link out to that.
Yeah, and I can't stress how vital that is. I'll wrap right here, Josh, if you're okay with that, because we got 1 minute. But, and look, you don't really, if you don't want to use us, you think, realtors are jaded, we're trying to get you to shop on our site, that's fine. But go to a live site. In a fast market like this, I can't tell you how often I have consumers email me overnight, can I see these 6 homes tomorrow? And then when I check that at 5 in the morning, 5 of the 6 are already sold or under contract. And that was weeks ago. And it makes consumers upset. They go, well, I just saw this on Zillow. You're lying. Zillow says it's for sale. I'm like, Zillow is not listing these houses. Their feed is out today. And it becomes crazy frustrating for your consumers that are shopping to spend, up to 1 in the morning looking at houses to find out they're all already gone and the site was out of date. So I won't say much more about that, but I teach classes on that. I've got a lot of data to show you where to shop. But in summary, for your personal situation, it depends on price demographic and where you are at in the market and whether you're first time or move up. We're experts, reach out to us. We're happy to give advice and we can really psychoanalyze your specific situation. Whether you're in Utah or outside of the Utah, Josh lends in all states. And I've built over the last 5 years a vetted, top producing network of realtors around the country as I've spoke around the country who speak like we do and know the market, their local market like we do. And we don't just have a list or an old Rolodex. We've got a software system that makes them responsive to you. So we can really answer your questions in any market around the US. And we will send out this recording to all of you. And if you've got any individual questions, just reach out to us. We're happy to answer them.
All right, everybody. Thanks for tuning in. Feel free to shoot us an email with any questions. We'll follow up with an email to you, checking in on you. And it was a blast. Thanks for attending. Thanks, Jake. Great job.